Benjamin Franklin once said, "In this world, nothing can be said to be certain except death and taxes." I have no idea if that's how Benjamin Franklin sounded, but hey, you get the point. In this module, we will explore the accounting for income taxes in US GAAP financial statements. Fortunately, we don't cover death. The Internal Revenue Service, IRS, imposes a tax accounting framework that can differ from US GAAP. Accrual basis accounting is used for financial statements, and the resulting income is often referred to as book or pre-tax financial income. Cash basis accounting is typically used for tax purposes, but this is not always the case. In addition, tax law usually requires less judgment, while GAAP accounting is filled with management estimates. Therefore, the US GAAP financial statements do not match the tax return for many items. For example, salary expenses are deducted from both book income and tax income. The expense in the books and the tax deduction are typically taken at the same time. Now consider the accounting for litigation accruals. If it is probable and reasonably estimable that a company will have litigation losses, US GAAP requires an expense and a liability to be recorded for book purposes. But for tax purposes, there is no deduction and therefore no liability until the litigation is settled and the settlement is actually paid. This is an example of a temporary difference that results in a deferred tax asset that is recorded in the financial statements. Deferred taxes are really the result of accrual accounting. Items recorded in the financial statements now will be included in the tax return in the future. Those future impacts on the tax return, such as the litigation expenses in our example, must be accrued for in the financial statements now. Note that it can go the other way as well, where items are recorded in the tax return now, but will not impact the financial statements until later. This also results in deferred tax impacts that must be reflected in the financial statements. ASC Topic 740 is the predominant source of literature in US GAAP for the accounting for income taxes and provides a methodology for recording income taxes known as the asset and liability method. This method focuses on the difference between the financial reporting carrying amounts of assets and liabilities and their related tax bases. These differences are called temporary differences and are identified by comparing the book and the tax balance sheets. Remember the litigation liability we mentioned before? This is a perfect example of a temporary difference, which we will learn needs to be recorded in the US GAAP balance sheet. As time passes, these differences will eventually be taxable or deductible when the related assets are recovered or liabilities are settled, and this difference will reverse. In this module, you'll be introduced to temporary differences and how they affect the tax provision.